Bring in our business correspondent, Paul Kelso, as the seconds tick down to this interest rate decision, which is due at midday, Paul. So set out what we might expect.
The markets, most analysts expect an increase of 0.75 percentage points, which would take interest rates to the base rate to 3%. It would be the largest single increase since 1989, if you ignore the aberration of Black Wednesday, when there was a rate that didn't last a day, and that is indeed what has happened. The base rate, we just heard from the Bank of England, has been increased to 3%. So that's a 0.75 percentage point increase. It's the highest rates have been since 2008. We've been saying that all year because we've been in this period of historic low interest rates. The rates came down after the financial crash. They'd not really started to rise before COVID, when they dipped to 0.1%. That's the lowest they've ever been. And we're now on this march back up. That's the 8th successive increase in interest rates at the bank's Monetary Policy Committee meetings, which happen every 6 weeks, which is where this decision has been made. We should say that the context of this decision, in the 6 weeks since the last meeting, we've had 2 prime ministers, 2 chancellors, and that loss of credibility in the UK economic situation. I'm not sure if we can show a chart which shows us the path of interest rates. I'm not sure if we have that. Yeah, there it is. And you can see you can see the climb back up. When the steps here, this skyscraper, you call this chart, they look a bit more like a Machu Picchu in profile, doesn't it? At the end there of the years, we said we've stepped up in 8 successive meetings. So this gives you an idea of what is happening here. Is the bank, in the face of soaring inflation, that's what's driving this. We have inflation above 10%. What the bank is trying to do here is squeeze demand in the economy. One of the tools it has is interest rates. Its aim, remember, is to get inflation down to 2%. So they're looking to squeeze demand to stop us effectively spending more by taking money out of our pockets through by increasing the cost of borrowing, which is obviously particularly affects mortgage holders. And the idea is you will then lower inflation and squeeze inflation. And what they're really worried about here is the inflation, that 10% inflation, is actually driven largely by rising energy costs exacerbated by the war in Ukraine. The thing the bank is worrying about, and I expect we will hear more about and more from our correspondent Ed Conway, who's been in a briefing from the bank all morning. It's very tightly controlled. He's not allowed to leave till midday because it's so market sensitive.
So he'll now be running along corridors.
He is making his way, if I know it, you do it in a vault in the banks, not with the gold, but it is a locked room, no phones, very secure, and he'll be making his way. But what he will have a sense of is what the bank is saying about where interest rates will go and what it expects to happen in terms of GDP, its forecast for the economic health. But what they're looking to do, the worry consistently has been that this imported inflation, if you like, through energy costs, becomes embedded, to use the terminology, through rising wages. We have a labour crisis in this country. We have more vacancies in the economy, forgive me, than there are unemployed people. That is increasing the push from employees for more money because it's harder to employ them, and of course they want their wages to keep up with inflation. The bank's worry is that becomes domestically rooted, so even when the energy price falls, and hopefully that happens, you've got inflation to stay. So that's what the rate rise, in the bluntest terms, is intended to do.
So let's just reiterate for anyone just joining us that the Bank of England has, in the last few moments, raised the base rate of interest by 0.75 percentage points, from 2.25% to 3%. That's the biggest single interest rate hike for over 30 years, and it also takes the interest rates, the highest rate since the financial crisis, since 2008, doesn't it, Paul? I mean, the worry, presumably, here is that when we find out a little bit more about the Bank of England's predictions of the direction that growth is going to go into in the country, that we could end up with a situation of still having very high inflation, but also very low growth. And there's this thing called stagflation, isn't there, where you get kind of stuck in this stagnant
Absolutely, and it's an ugly word, and it's a pretty ugly economic state to be in. The bank, remember, last time, certainly the last time the governor spoke at length, was expecting the UK to be in the start of a 5-quarter recession, so expecting to be in recession now. That is, the economy contracting and lasting through all of next year. Now, this is the balance they're trying to work effectively. I mean, the bank does want to slow down the economy. That's what raising rates is about. It's trying to take the heat out of the economy. The balance is not tipping the economy into recession, which starts to hurt people even more. One of the things we want to see is where is the peak going to be? Because there's a hope that in rates and inflation itself cures itself as a brake on the, because the more prices rise, the less we can afford to spend. So it might dampen spending, but this is a balance that this is why central bankers are employed to do this job and why it's such a tricky one. But the intention certainly was to try and cap this. Interesting too to hear what they have to say about and what the market says its assumption is of where interest rates will end. Remember, after the mini budget and what flowed from that, the huge increase in the cost of government borrowing, the markets were assuming interest rates would be above 6% by next year, and that will have huge consequences for mortgage holders. The fixed rates are already above 6%. They have backed off. That expectation now is that it's perhaps around 5% is where the bank will have to keep raising rates. Will this rate rise do enough to knock that back?
OK, Paul, I'm pleased to say that Ed Conway has escaped from the vaults. He is free to talk to me now, our economics and data editor, of course, Ed Conway. So you've been there in the Bank of England with a briefing from them. This decision to raise interest rates also comes alongside an analysis of where the bank thinks the economy is headed. So, Ed, what have you learned?
Yeah, it does. I mean, so, first things first, I'm sure that Paul has already covered this, but, it is a historic moment. They've raised interest rates more in one go than they have done for more than 3 decades. There was a brief moment in 1992 where they raised them by a little bit more than this. It only lasted 24 hours. So really, this is the single biggest increase that we've had since 1989. It is a big moment. Obviously, they've been raising rates quite quickly in recent months as well, now up to 3%. That will have an instant bearing. If you have a floating rate mortgage, it'll have an instant bearing on your mortgage. And of course, it will also have a bearing on many other kind of borrowing costs across the economy. But yes, as you say, Anna, there are all sorts of other things going on as well, because the bank doesn't just provide their decision on interest rates, they also give us a sense of how the economy is doing right now. I'm afraid the story there isn't especially good. They say that we are already in recession right now. The recession has already begun in the third quarter of the year, and it could well, and I'm just saying this to couch it slightly, it could well last a long time, maybe as long as 4 quarters of successive contraction. And when we're talking about recession, what does it mean? It means the economy, gross domestic product, basically shrinking. And the technical definition of a recession is just when it's shrinking for 2 quarters in a row. But in broad terms, it means we are not in a good place. The total amount, the sum total of income we're generating across the economy is shrinking. They say it could be a very long, very protracted recession indeed. But there's a massive proviso over that, which is that they're concerned that right now markets, and when we're talking about markets, we're all pretty familiar with this now from the last few weeks, money markets out there, gilt markets, the markets where people are making decisions about whether they're buying into the UK, what they're doing with UK government debt. They say they are expecting higher interest rates than really look likely. They've given a really firm signal, firmer than I can remember in a long time, to suggest that while markets at the moment think the rates could be heading up towards about 5%, the bank signals that's not necessarily likely. So in a paradoxical way, although they're raising rates by 0.75%, that's a big amount, they're saying the eventual peak in interest rates might not be as high as a lot of people had expected, which could, of course, have a bearing on what we're seeing in markets at the moment. It could mean that fixed rate mortgages, which of course are based on those expectations, could actually start to go down a little bit in response to this. But really, we have to wait and see. We have to see how markets react, and I'll have a look at, I literally haven't looked at that since I came up from the vaults to get that analysis. But we'll also see what the governor has to say. So we'll be hearing from the governor, Andrew Bailey, in a press conference, and we'll be talking to him on Sky News a little bit later on as well. But yes, a big day for the UK economy. Interest rates rising faster than we've seen in any previous decision from the Bank of England in 3 decades, getting up to 3%. And it essentially diagnoses that we are already in a recession that could really be quite protracted.
And did they say anything about where inflation would peak?
So their expectation is inflation is kind of more or less going to peak kind of round about now. So you've got that moment in October when we get that increase in energy prices. The energy price guarantee, of course, meaning it's going to be £2,500 on average for households. That's about 11% inflation they're expecting around now. But then it stays pretty high. And a lot depends, to be honest with you, and they don't really know about this either. It depends on what the government does in April, when that 6 months comes to an end, and when it basically decides what it's going to do with energy prices in future. We don't know about that yet. And the other big thing, actually, that the bank doesn't know about, and it's another reason to be a little bit cautious. I mean, there is no getting away from these numbers. They do not look good. The economy in recession right now, potentially, it could be quite a protracted recession, although it's worth saying, when we're talking about the length of the recession, that's a length of time. The depth of the recession, so how far it goes down, how much of a dent it's making in all of our incomes across the economy, that's not as bad, according to their forecasts. Even in those kind of quite gloomy forecasts, that's not as bad as we saw in 2008. It's not as bad as we saw in the 1980s. It's kind of comparable with what we saw in the 1990s. But you've got these other factors. You've got high inflation, which, of course, you mentioned. You've got high energy prices, which are a part of that, in fact, a big part of that. And then you've got higher mortgage costs. And that's obviously what we've just had formalised in the Bank of England today, bringing up those mortgage costs for households across the country. And you're facing that kind of three different factors coming at you from all different sides, which means that the amount of kind of spare income that people have over the course of the next few years won't be as much. And that's what's pushing the UK into this recession right now. Of course, we will hear as well from the Chancellor, Jeremy Hunt, about what their plans are. I mean, they have their autumn statement coming up. They're unlikely to give any kind of hints about what they're going to do. But it's worth saying what this has done is laid out a pretty bleak outlook for the UK economy ahead of that decision. And of course, if they are going to be cutting spending, raising taxes on top of all of this, that might well mean that the dip for the economy is even worse in the coming years. So it's pretty tough times. A couple of other things I should mention. Unemployment, the bank talking about unemployment getting up to a peak of around 6.5%, maybe even higher than that. That would be the highest that we've seen since the financial crisis. Of course, it was kind of up at 8% or so during the financial crisis. And the other issue is mortgages. They think that on average, if you've got a mortgage, then your costs, obviously it all depends on when you're refixing, but your costs could go up on average by about £3,000. That's an average figure, but £3,000. Now bear in mind that that is actually bigger than any kind of compensation that households are getting, those who have mortgages, from the energy price guarantee. You see the issue. You've got energy prices really high. At the same time, those mortgage costs coming up as well. And the bank's saying in order to get inflation down, it's having to raise interest rates right now, which is making life tougher for everyone. So unfortunately, there's bits of news that aren't especially palatable there.
No, absolutely, and we're getting more of that, aren't we, at 12:30 when the Bank of England governor holds a press conference. So we'll get more answers to those questions as well. Ed Conway, thanks very much indeed. Plenty more analysis, of course, throughout the day.